How do we value our favorite company? This is what we are going to see today. In my previous video, I have shared one of the methods of arriving to the fair price of the company, that is by using the discounted cash flow model. And today we are going to understand the Buffett method of valuation of a specific company. So let me share my screen so that we can quickly jump into the steps which are required to use the Buffett method. So this is the this is the PPT. So first step is to collect our historical information. And this historical information we need to collect with respect to the earning per share of the company. I'll use a highlighter. Let me take red. So earning per share of the company. And then we take our book value per share of the company. And then we take our dividend per share. And then we also look up into our price high and price low for each and every year by checking into nseindia.com. There, if we select the year, we directly get the price high and the price low, that is our stock price for every year of the company. So now that we have our historical data with respect to EPS, BVPS and DPS as well as the prices, we then go into our next step, which is we calculate the P ratio of both the high value as well as the low value for each year. Once we calculate the P ratio, we also calculate the PB ratio for each year. Once we have calculated the P ratios, we then identify what was the growth rate of EPS, what was the growth rate of BVPS, and what was the growth rate of DPS as well. Once we identify that, we calculate the averages, what we determine in step 2. We determine the average P ratios for high, and then we identify the average P ratios for the low as well. And similarly, we do for the same for PB ratio, price per book. Once we have identified the growth rate of the company with respect to earning per share, with respect to book value per share, and with respect to the dividend per share, we project the subsequent 10 years of the growth rate of the company by taking the last value of EPS or by taking the last value of BVPS as well as DPS, that is the dividend per share. We sum up the dividend per share for all the projected years, and then we project all the EPS for subsequent 10 years as well as the book value per share. We project the required book value based on the growth rate which we have already identified for the historical rate data. Once we have noted down all the values, that is the projected value of EPS is available and the DPS values also are available, we note it all down. And once we note down all the values, what we do is we see the last EPS of the company. We take the last EPS of the company and then multiply that with the average P ratio of the company and then add the dividends to that to get the actual gain which we can derive in future. Once we arrive to the future price gain, what we decide is we take the future price gain, we check what is the price today, and then we use our compound interest formula to determine the rate of interest if we have to put capital today. So then we can tweak saying that if I want to achieve like 15% or 16% growth rate, then what is the price I need to buy today? That also we can do. So these are the steps for using the Buffett method for arriving to the fair price of the company. So now let us go into our illustration. Let me stop this and share the Excel. We are continuing building upon the same Excel. In my last video which I shared, it was about the discounted cash flow model. And today we are going to see the Buffett valuation. So in the Buffett valuation, we first populate the historical data of earning per share. This earning per share comes from our net income statement, that is our profit and loss statement. So we look into our profit and loss statement. In our profit and loss statement, we have already calculated our diluted EPS by taking the considerable profit after tax and then dividing it by the total number of shares outstanding, which we have picked up from the summary page. This we do for all the years, and then for each respective year, we put into our historical company data table. Now that we know the EPS, we calculate the DPS of the company. So we go back into our P&L. For dividend per share, we take the total dividend and divide it by the total outstanding shares to get the dividend per share. Once we know our dividend, we populate these values into a Buffett table. Buffett table. I remember food Buffett table. Just joking. So we have our dividend per share. Now that we have identified dividend per share, let us see our book value per share. So here we take the shareholders equity, which is from our balance sheet. And once we take the shareholders equity, we divide it by the total number of shares, which will give us the equity per share of the company. So book value, as you see here, balance sheet, refer B6. That is, we take the equity share net worth and we divide this value with the total number of outstanding shares. So once we have this value, we project it for, and we not project it, we take the values, historical values in fact, for the book value for all the other years as well. What we have done is we have taken for 2022 until 2018. So this is shown in the reverse order, current year first and the previous years later. So the price we look into our nseindia.com. In case you don't know how to look for the high and the low price from nseindia.com, please drop into a comment section and I will be glad to show it separately. So we go into nseindia.com, we note down all the high values for all the years and we note down all the low values. And then we calculate our P ratios. I've already demonstrated in some previous video how to calculate a P ratio. We take the price, the high price, which is 1823.4, and we divide it by the EPS of the company. This year's EPS, which is B18. So likewise, we do for the previous years as well. Once we get our P ratio for high, we calculate the P ratio for low as well. How do we get the return on equity? Return on equity is the profit divided by the BVPS, that is our book value. So we take the profit, which is our earning per share, and we divide it by the total shareholders equity, which is our book value per share. Once we get this ROE, we then calculate our payout ratio. Payout ratio is the dividend distributed to the company based on the net profits earned. So the dividend per share of the company divided by the earning per share of the company will give us our payout ratio. Once we derive the payout ratio for all the years, that is 5 years, then we are now ready to determine what was the CAGR of EPS. To determine the CAGR, we use the compound interest formula again. We take the latest year divided by the last previous year available, that is 25.2, and then we raise it to the power of 1 by the number of years, which is 5 years, and then subtract it by 1 to get the actual percentage. So which is 9.5%, and then for DPS it is 7.9%. For book value per share it is 2.6%. The high price and the low price has grown to an extent of 6.1 to 6.5%. So now that we know our compounded growth rates, we now are ready to project the future growth rate of the EPS, book value per share, and the dividend per share of the company. So in our first method, we first project the EPS of the company and the DPS of the company. We take the last EPS, that is our latest year's EPS, which is 39.6, and then we project it based on the growth rate of the earning per share. We project it for all the 10 years. We could project it more further, but it doesn't matter. We could have done the projection even for 5 years. It would arrive to almost the same value. And the dividend per share, we calculate the dividend per share by projecting the dividend per share based on the growth rate. So I have picked out here EPS. Let me take the C value. So C, this is our dividend per share. And then we take the last projected earning per share of the company, and then we sum up all the dividends of all the projected years of the company. Once we have arrived to the last earning as well as the sum of the dividend, we project the price by taking into account the P ratio of the company. As you know, we have arrived to the P ratio of high and then P ratio low, and then both this again we average it out to get the P ratio. This is the average P ratio, which is 45. So to this 45, we multiply the earnings after 10 years, which is 98.23. 98.23 multiplied by 45, and then adding the dividends, that is 314.32. So this is the projected price which we get. This is the projected price 10 years hence. So once we know the projected price, what we do is we identify what is the price today. So based on this price, what is the price gain? We use our compound interest formula again, and then we see that we get a gain of 12%. If we put our capital today into Colgate-Palmolive, we can expect 12% rate of return after 10 years. So which is much better than a fixed deposit in any case, and it is higher than inflation also. But nevertheless, I'm not happy with 12%, so I want 15%. So if I want 15%, what should be the fair value is the next formula, which is our reversed formula, which we have seen in our discounted cash flow model. So we use that formula to derive to what value we need to wait the stock price to come to so that I can achieve 15%. Or if I put 16%, then this is the fair price which I need to wait for. So this is based on the EPS model. Now we look into our book value per share model. So in book value per share model, it is almost similar to the EPS model. The similarity is basically we project the dividend per share. We take the last dividend per share of the company, which is 19. So we populate here 19. My apologies. So this is calculated based on the earning per share. So we first take the book value per share. We take the book value per share as the latest book value per share of the company. And then to this book value per share, we can determine the earning per share based on the book value. So we take the return on equity multiplied by the book value per share to get our EPS of the company. So now based on the EPS, let me go to B49 is the book value per share, and H4 is our return on equity. If we scroll up to H4, H4 is our return on equity. This is the average return on equity, by the way. So once we know this EPS, we can calculate how much dividend we need to pay out to the shareholders by taking the EPS of the company and the average payout ratio. So the payout ratio is 80.6%. So this is the value which we take in our projection table, which is 30.7. So now similarly, we calculate our next year, subsequent year's book value per share. So subsequent year's book value per share will be an addition on the previous year's book value per share and the retained earnings, right? So the earning per share of the previous year minus whatever distribution, the dividend has been distributed by the company, that delta we add up to get the subsequent year book value per share. And once we get the subsequent year's book value per share, of course, it's easy now to identify the earning per share by taking into account the book value per share of the company and then multiplying it with the shareholder return on equity. We take that and then we calculate based on our dividend payout ratio, we calculate our dividend per share. Likewise, we do it for all the subsequent 10 years. And this is what we arrive to our final year's earning, that is at 10 years hence. So this is the earning after 10 years based on the book value per share. And based on this model, that is the book value per share model, this is the sum of the dividends. So now once we get the total dividends, we again do almost the similar step, whatever we did in the earning per share model. We take the P ratio and then multiply it by the last price, that is 114, and then we add up all the dividends. Once we add up all the dividends, this is the projected price which we arrive to. Now that we know the projected price, we can determine what is our today's price by looking into nseindia.com and then determine if we invest today our capital, what is the returns we can expect after 10 years, which is 14%. So what I typically do is I take an average of EPS base as well as the book value per share basis. So the average what we can expect if we invest our capital today is about 13%. but now I want like 16%. So if I want 16%, based on EPS model, it is 1073, and based on the book value per share model, it is 1303. So if we go by this, there are two different fair prices. So we can take an average of both and then arrive to our new fair price by taking this value, fair price, based on EPS, based on book value per share, and then we divide this two to get the average fair price of the company. So 1188.29 is the price which we can invest today to expect a return of 16%. But nevertheless, today's price is 1581. So we need to wait for the max we need to wait for is 1303. Below that, probably we can apply the margin of safety again here to then start buying into our shares. So this is the Buffett method of valuating a specific company, and this is a method which I use commonly for most of my stock analysis. And then I have one more method as well, which I have derived on my own, but the basis of that model, the third model, is the Buffett method, and the third model which I have derived is much more simpler. It is much more easy to calculate. Is not required to get into too much of analysis paralysis, because whatever model we use, there are certain advantages and disadvantages. Probably I will take up that in a separate video. So until then, please subscribe so that you can look into my third model, which is very simple and very easy to use. Okay, until then, see you.